Hey everyone, on today's episode, we're going to talk about startup costs. And why is that important? Because there is current guidance, and there was recently a ruling where people who thought they started their business were disallowed all of their startup costs by the IRS. They were like every single dollar was pretty much reversed and taken out, and the court sided with the IRS. So how do we avoid this pitfall? How do we get it such that all our startup costs become fully deductible to us? We're going to go over all this in a bit. Okay, so the story starts out with two ambitious business owners. Let's call them Kwaku and Ashley, which are actually their real names. And they go off on a business venture. They drop $40,000 on education, training, materials like these kind of startup costs. And they deduct $40,000 through, their business return, and the IRS disallows each and every dollar. They completely reverse the whole thing. They go to tax courts, and it's not going to be cheap. Anytime you're going to tax court, you're hiring a lawyer, you're doing all this, and the tax court sided with the IRS on this. And really, what was at play is the tax court ruled that they hadn't really started their business. Now, what qualifies you as starting the business? In their view, there's pre-start activities and operational activities. So pre-start activities are, buying tools, education, online course, forming the LLC, forming the entity, all that. And then there's the operational activities, which is actually doing the marketing, going out and finding a client, signing contracts, starting work. Now, anytime there's pre-start activities, in their view, your business has not begun yet. Just because you have an LLC set up, you have your bank account set up, the EIN, all that, does not mean your business has begun. So at that point, what ends up happening is they only allow you to deduct up to $5,000 of expenses, which, as we know, is not much. And they're gonna have you amortize the remaining amount of those pre-start activity costs over a 180-month period, 15 years. So really, it's going to be a drag. If you spent $50,000, $100,000, whatever it is, buying your tools, buying your van, doing all this, and you put it all in that pre-start activity period, you're only going to be able to deduct annually like that amount divided by 15, pretty much. So like 5,000, they're giving you, as an immediate expense, but the rest you're gonna deduct over a 15-year period, which is very painful. So now, if you do everything right and you set yourself up to, hold yourself out as having started your business, then you won't have this problem. Now, what exactly do the operational activities entail? It's starting your marketing, sending your first bid, signing your first client, and collecting your first payment. Now, if you can show you've done at least these four things, by all means, run through all the business expenses that are necessary, and you shouldn't have a problem in this respect. Now, before you actually do any one of these activities, again, I'll be very cautious of running anything through. So let's say you're a concrete contractor starting a new division, maybe a concrete restoration side hustle or a development arm, whatever it is. That's a little, you want to separate it or give it 1 degree separation from your current operations. Setup costs: new truck, equipment, insurance, training, all the typical stuff. So if you haven't started bidding or delivering work yet, you're still pre-start. And mind you, of course, I always have to advise you on the right way to do things. A lot of this is if you got flagged for an audit. So the number one way to not be flagged for an audit is you do not want to show an entity with all expenses or a bunch of expenses and no revenue in a given year. That will definitely increase your audit risk. So that is something we want to avoid entirely. So to make full circle on this episode, if you haven't started bidding, you haven't gotten work and received payment yet, you're still pre-start. You can only deduct up to $5,000, and everything over the $5,000 you have to defer and amortize over a 180-month period, 15-year period. If once you've marketed, signed that first client, done the work, collected payment, that point in time or that series of events makes you operational, and therefore you can start deducting all your business expenses. So I hope you found this episode helpful. Click like, subscribe, turn notifications on for any updates, and hope to see you in the next one.